Stocks rose to record highs on Friday as investors received a disappointing April jobs report. The jobs report indicated 226,000 non-farm payrolls versus the 1 million plus number that was expected. Further, the unemployment rate was 6.1% versus the expected rate of 5.8%. But please move on as there's nothing to see here. And with that, the S&P 500 and the Dow each reached new highs. The Nasdaq also advanced after it became clear that the monetary policy needs to stay on hold and interest rates also need to stay low, and that's good for growth stocks. After sinking immediately following the jobs report, Treasury yields steadied with the 10-year just below 1.6%. As I told you recently, I want you to watch the Treasuries, as this may be a key to the direction of the market in the mid to long term. For now, maybe expect a rise in the yield, but watch more closely in a month or two from now because there is still risk in the market. So, let's take a look at our charts. But first, a quick check with the Volatility Index, the VIX. And as you can see in the upper left, the symbol is $VIX using stockcharts.com. And essentially, the Volatility Index is a contrarian indicator, at least it is for me. And as you can see, we topped out here at this point. But since then, things have been on a slow ride down, and it looks like we're continuing on down. We were riding along that 20 level for several months back here, but we broke through that in late March and we're sitting here at about 16.69. So to me, that means things are going to be sailing at least for a short while. And you can see the same thing up here in the upper portion of the chart with the RSI. We're under that 50-year midline at 42.89, so things are pretty calm. And down here at the bottom of the chart, the MACD, you can see that it is also below the zero line. So all is calm, at least for now. Okay, let's go to our charts. And we're looking at the 2-year weekly chart on the spiders, the SPY, and the close on Friday, 422.12. Now, following a plunge there in March of 2020, subsequent to that, from about June or July of 2020, we have been riding above that 20 EMA, with the exception it pierced below here and then also here. But for the most part, we've been riding up above that. Now, the separation here between the chart and the 20 EMA, that's pretty wide. We got pretty wide at this point here, and of course we corrected, and this was relatively wide, and we definitely corrected there. So there is some risk in the market, but it doesn't seem to be too extreme at this point. Moving on down, volume doesn't show you too much. I don't like the fact, though, that there is a decline in volume. So that is something to keep in mind, but it's not too dangerous, at least at this point. And the MAC here, the fast line is above the slow line, and just a very minor kick up in the last, say, week or so. But that's not really too much of a concern either, and it looks pretty nice. Moving on up, no real hesitation or any sign of things slowing down. Same thing here in the histogram, and then into the price rate of change. Look at that, all the way back from that July 2020 period through here. We're just going sideways in this channel, and as long as we can stay in that channel, things are going to be hunky-dory. Now, relative strength is kicking up here, not quite into the overbought territory, which would be above that 80 level. We have to watch for that because once you get above that 80 level, then definitely the risks do increase. So we're not quite there yet, so I think we still have some time. And then into stochastics, it looks like the slow line is heading on up. The fast line came up, came back down, and is just riding that wave. And I think that's going to continue here for a while. So into the Williams, not going to show anything all that different. Back up here to the price chart. Things are looking pretty good. Things are awesome. So at least for now, we're going to continue on relatively calmly. And for today, that's ChewDog Charts. Thank you.